Abby, you have seen this too many times before. The angst of the ambiguity, up we go, almost the fear of economic and GDP success. How do equities react when you get a surge in GDP as we anticipate?
Well, Tom, first of all, thank you very much for including me today in the discussion. It is an important day and an important week for women. You are asking exactly the right question about the markets, and that is this. Is it good news or bad news for the economy to be recovering? And I would say it is good news. Now, we are seeing, of course, this very significant rotation in terms of views. Those stocks that have performed extremely well only because interest rates were down and low may have a problem, but there are plenty of other opportunities in the equity market as we do see a rotation towards those stocks that do better when we feel more comfortable with the pace of economic recovery and hopefully over the next couple of years, true economic expansion. These, of course, include the small cap names, also the value names where there's been this wide gap in things like PE ratios and so on. We're also seeing an improvement in stocks that are rate sensitive. There are some securities, some companies that do better when interest rates are a little bit higher. And we, of course, are seeing some movement now in those sectors that do better when we come out of lockdown. And the good news on the vaccine will, I think, be helpful. And, of course, those areas include things like restaurants and accommodation.
Abby, I'm not going to mince words. Goldman Sachs has been out front on a bull call. Costin has led the way to SPX 4300. What does the gloom crew get wrong?
Well, the argument behind this really great outlook from David is also based upon the above consensus view from Jan Hatzius, our chief economist, who believes that this year the U.S. will see GDP of close to 7%, and it's even better fourth quarter over fourth quarter, basically about 7.7%. And that's based upon, let's say, four factors. Number one, this very robust fiscal package. Number two, the Fed staying basically friendly. Number three, the virus-depressed sectors beginning to rebound. And also, let's remember that there's an awful lot of pent-up savings in the economy. The average consumer balance sheet, and again, I'm looking at the median, there are many exceptions, but the average is actually looking good. Debt balances are down, savings are up, and when people feel a little bit better about the outlook, they'll start to move forward and start spending, and that's great for the economy. But you asked about the gloom crowd, and I think what the gloom crowd keeps coming back to is that there could be an uptick in inflation. Wouldn't be surprising. That's built into Jan's forecast as well. But let's look at inflation as being a function of two different things. Number one, there are some special factors happening this year. Maybe it's the energy prices and so on. And there's also, of course, that quick rebound in prices from the very depressed levels that we saw in some sectors in 2020. But the second important reason that inflation may move up a little bit is that we are seeing an improved economy, and I think that's great news. You know, it's the opposite side of the coin. On one side, the economy is doing better. On the other side, prices are not quite so depressed. The Goldman Sachs forecast on CPI does show it moving up from about a 1.1 last year to 2.5 this year. But in 2022, we're looking at CPI of about 2%. By historical levels, that is not a problematic level for inflation. And by the way, that is the Fed's target level for inflation, about 2%.
Abby, you've seen it all. And many people come on this program and they try and look to history to find a parallel with the moment we're in right now. How original is this moment, and what makes it unique?
That's a great question, and I think what makes it unique is that none of us, regardless of how long we've been in the markets, have seen a pandemic-inspired recession, bear market, and now, of course, the recovery. And what pleases us in terms of what might happen is that we are seeing policies that are aimed at providing relief. So we've had a friendly Federal Reserve, and other central banks are doing what they can as well. And now, of course, we have this very meaningful relief package coming in the form of fiscal policy. And I think it's important not to categorize this totally as a stimulus package, because it's not. It's a relief package aimed at getting us out of the hole. And the next important thing to be watching is what the Congress can pass and the president can sign with regard to really moving us forward. And that would include things like the infrastructure reform, things like addressing some of the big issues in the labor markets, and there are some underlying problems that really must be addressed and are not quite addressed yet, even in this very large package that we expect to be signed into law later this week.
Abby, that's on the fundamental side, or it's become the fundamentals in terms of fiscal support. There's also a question on the technical side, what that means in markets. And we've seen coming into this year is different also because the global reflation trade has not come along with a weaker dollar. In fact, the dollar is stronger against every single emerging markets currency, major one, out there year to date. And we're looking today at the biggest sell-off in the MSCI Emerging Market Currency Index versus the dollar going back to last March. How does that alter your views going forward? Or do you think that this is the indication of a different regime where the dollar can strengthen, yields can rise, and that doesn't come along with the rest of the world improving at the same pace?
Yeah. So let's step back for just a moment. When we do currency forecasts, obviously we're looking at all the same factors that other people are. But one factor really has dominated since the beginning of the pandemic, and that is the safe haven nature of the U.S. dollar as the world's reserve currency. And if anything, that has been somewhat enhanced over the recent past, in part because the United States has been able to take somewhat more aggressive measures than other nations in coming out. And we also are now looking a little bit better in terms of vaccination rate and so on. What happens going forward in 2021 will be a function not just of us, but is true of all currencies. What happens to other nations? So far, we have seen some disappointment with regard to some of the emerging economies. But one thing we should all be watching is whether an improved tone in U.S. economic activity will help bring our trade partners along with us. And that certainly would be a good news scenario.
I know, John, you mentioned that last week. Abby, one final question, if we can, on this day, as we look to women like you that were out front. You know this, and I know this from the CFA Institute, that securities research led the way, whether it was Abby Joseph Cohen, Louise Giammatta, what Sally Krawcheck did at Bernstein, and the wonderful Alice Beebe Longley, who I read religiously years ago, I believe, at DLJ. How do we impart what securities research did with women over to other parts of the financial industry?
Tom, it's a vexing question. What we basically see in financial services and some other industries as well, is that there may be a large number of women coming in at the bottom end of that pyramid, and we all have to do better, not just in financial services, but other industries, in enhancing that pipeline. So, for example, we do see that women are well represented in a number of industries, but as you move up, say, to the VP level or the MD level, that's where we see a flattening out. And by the way, while we can point to problems here in the U.S., it's worse in most other countries. And so they're looking to us, interestingly, to get things better. But let me spend just one more moment. You know, we tend to think about these professional white-collar jobs. The real problem for many women in 2020, this has not been a good year for women who are really on the front line, those who are heavily represented in some of those virus-afflicted sectors, including restaurants and accommodation, but also in state and local governments, where women tend to be overrepresented by numbers in positions like teachers and social workers, And over the last year, state and local governments have, in fact, reduced jobs by something like 900,000, and that affects women much more dramatically. The labor force rate for women now is much lower than for men. If you look at adults, it's about 70% participation for men. It's only 57% for women. And this has long-term consequences in terms of potential scarring of the labor force, especially for women.